Sold at 560.
785 the first, 785 the second, be sure, 785 the third, final time, sold. The third and final time at £910,000, sold.
Well, good morning, everybody, and welcome to the latest edition of the Allsop Prop Chat, the podcast for people who understand real estate. My name is George Walker. I'm from Allsops, and I'm joined by my colleague Richard Adamson today, who you'll be familiar with, and some special guests on the panel. Vijay Parikh from Harold Benjamin Solicitors. Morning, Vijay.
Good morning.
Harold Benjamin, winner of a property award this year. I mean, you're in charge now, Vijay, haven't you? We've known each other for 20 years, and suddenly you're all important.
Well, it appears that way. We've done a lot of work over the last 20-odd years, specialising in auctions and really knowing the market. So it's great to be here. Thank you.
Yeah, I mean, you cover the wider breadth of the business, don't you?
Yeah.
Hotels, development, construction, everything else. And Seb is one of those folks on the Allsop roster that is alarmingly intelligent and has access to all sorts of different data. So, Seb, was the budget fun to interpret?
Bless you, George, for that. Yeah, it's not just the budget. It's been rather a busy 7-8 days. I'm still reading through the MPC notes from yesterday. Yeah, I'd prefer if it wasn't quite this lively in such a short period of time, to be honest.
And then the US elections come along to make it all a bit more interesting.
Yeah, made everything very spicy the last few days. Yeah.
It's been busy, hasn't it? Mm. Richard, 35 million only yesterday. You just put the rostrum, the hammer down. How was it?
It was good. I mean, we had an auction yesterday. It was a smaller auction because it was effectively an additional auction, if you like, from our normal roster and schedule of auctions. But actually, putting that into perspective, 2.5 weeks prior, we had a 2-day sale. So put those two together in a space of 2.5 weeks in the residential market, we've raised over 100 million at a success rate collectively well over 80%. There's a lot of negativity out.
100 million in the last 3 weeks?
Yes. Yeah. Quite comfortably over that. So it's been a very busy few weeks for us, and has been a year and a half, I suppose. It's been pretty busy. I mean, there's a lot of negativity out there for good reason in terms of what's going on in the wider economy and abroad. But the residential market still seems incredibly robust. It's absorbing lots of these hurdles that are thrown at us, and there is still money out there, people out there that want to invest and want to buy property, and that's encouraging to see.
In the hundreds, by the look of it.
Yeah, there's plenty of them, and I think the market is in a much better place than it was this time last year, and it certainly is a much better place than it was 18 months ago when interest rates were still creeping up or not doing anything, and we didn't know if they were going to stay as they were, go up or go down. And that uncertainty, certainly in our market, and I'm pretty sure in yours, creates a pretty difficult trading market. Now we know the direction of travel, if you like. It's starting to go down as of yesterday. Whilst it might be priced in, it's giving people confidence they know where the market is heading, and that's what we like. And we're starting to see that. More people coming back to the market, not in droves, but there are buyers out there that see grassroots and positivity out there and therefore want to invest.
Yeah, I think the commercial market is, sadly, we don't do the volumes you do. I feel like the second cousin at the moment. But £50 million of sales on the 5th of November. We timed it just after the budget. We've been talking about the budget for so long. I think the market's has been resetting. I was really encouraged in those sales. We had some, what I call very old school money. Obviously, we've been around a long time. I was involved in the Barclays Bank lease about 15 years ago, just after the financial crisis. And we saw the same people bidding this week that were buying long-dated, fairly dull, income-producing assets 15 years ago. They were buying them this time because they understand real estate. They're happy with it. And I think that's a pretty good sign. The market's on its way back very strongly. And we had this similar situation where one or two very big assets for us, £5.5 million of Holborn, couldn't be concluded in the private treaty market, but we put it out in auctions. And it's happened every auction this year. These bigger assets, people are waiting for them and they want the chance to buy. So all that adds up to £50 million and a pretty strong day.
Who's selling, George? Is the profile of seller over the past 18 months or even past few months? Has that changed since things have started to look a little rosier?
Yeah, I'm thinking about that. There are always people with reason to sell, and I don't think people are necessarily catching the market. I think what people have acknowledged, there isn't a lot of good quality stock out there. And so when Heron put some properties out in the market over the summer, as part of what they do, Threadneedle and other funds are, and we've got 2 REITs this time. The REITs have results season coming on them. They have stock market to keep an eye on. That this drives sales. They want liquidity. But there isn't really much consistency. The bulk of our seller is still the privateer. for private propco. But no one's was actually in our market was trying to beat a deadline. They were just right. This is what we have to do in the next 6 months, so they did it. The buyers, so it's all quite an interesting mix. So Vijay, what were your clients up to?
Well, it's quite interesting when you mention how the auction markets, certainly the commercial property auction markets, you're seeing the old buyers coming back in and buying properties. A lot of my East African and Asian clients who are heavily invested in the properties from the 70s onwards walked away a little bit from the market and went into lending about 5-6 years ago. And now it's very interesting that I've been asked to look at auction documentation, or firms been asked to look at auction properties where long-dated income. So, yeah, there is certainly an appetite, and there is a lot of money out there looking for a home.
Are they looking at it because it's stock that's available, or they're deciding this is time to get back in?
I think it's a bit of both, really. There's always scarcity of stock, good quality stock, and that gives an opportunity for buyers to come back in. But also, I think the opportunity is now to come back into the market, considering that there may be some uncertainty interest rates where they are at the moment, whether they're going to be sticking with inflation, I don't know. But yeah, they're taking the opportunity and they're not really getting those returns where they were lending the money. So
an optimist's view is that risk is good for real estate.
Yeah.
Where else are you going to put your money now, following this week? Equities? Bit risky. Far more volatile post-Trump election. Other countries, commodities. I mean, gold or real estate, if you're going long. It's always been a kind of a safe haven to a degree if you pick the right asset in the right sector, and more so in times when people are a little unsure about certainly the short to medium term outlook.
And a couple of shocks this week has made it even more uncertain. I mean, the stock market is going up and down like a yo-yo, isn't it?
It will do. And it will do until certainly Q1, Q2 next year, when we vaguely have an idea of what a Trump administration looks like and might do early next year. Before then, it's just complete speculation and people making almost day trade gains on the rumour.
Do you think, from where we sit in little old UK, do you think we were getting very jazzed up about the budget? Do you think that the American result has more impact than our budget?
No, not in the short term, I think. I mean, our budget has actually got a couple of fairly seismic impacts on our economy and our trajectory for both inflation and interest rates, which Richard's saying downstairs earlier, we might only now get 2 cuts in the next sort of year to 18 months, whereas I think the markets had accepted we were going to get 1 per quarter until the end of next year. That's potentially going to dampen appetite, or certainly dampen competitiveness for funding in real estate across all sectors, certainly less than we were. And that chimes also with the OBR's sort of assessment of the budget as well, which is actually there might be a small temporary positive blip in GDP off the back of this, but actually come to the end of the 5-year forecast horizon in the 5-year government, GDP is where it was going to be. So it's not a massive...
I think that leads us on quite nicely, Seb, to go actually more in depth as to what would your, in a nutshell, snapshot be after a week since the budget, the impacts of what were delivered. How's that going to play out in the next 6 to 12 months for the UK residential and commercial property markets?
I think it tempers some of the anticipatory enthusiasm we perhaps had. As you say, we came in at the start of this year, everyone waiting to get it back into the market. Everything's going to get so much better and rates are going to get cut. And, oh, hang on a minute, not quite as fast as we thought. And then we got through the sudden surprise election and we thought, oh, good. Everything's going to calm down now. We're going to get political sort of stability and we can then crack on in Q3. Oh, hang on a minute, we weren't quite expecting this budget to do what it was doing, and the scale of some of the debt we're talking about, and the impact on bonds, the impact on government borrowing, and then the impact on inflation through NI and so on, and the minimum wage change. So it's still the same pattern kind of 2 steps forward, 1 back. And there are, I think, some changes in the budget, which we, certainly from a resi perspective and from a smaller scale resi perspective, which are both sort of reputational and sort of tone of being an investor in that space changing even more, and also practical, which from a resi perspective, I think it raises serious questions about the role of the small scale investor in residential and how welcome they are from a rental perspective by government. And does the government have a plan for let's say the buy-to-let investor or the small scale landlord, which I don't think is answered.
It's a really good point, because if you Rich and I have talked about the audience who we hope listening. We think it's the 5 to 50 million pound portfolio owner. It's going to be mixed use, to do some development, some refurb, commercial and resi. That's the sort of tone. So it does seem to be an anti-private buy-to-let landlord agenda. And is there anything in the government's thought that acknowledges that and indeed compensates for it going forward? Is it the very fact that getting a flat to live in London, the rents are just going to go up? Is there anything built in to compensate for that?
The old DCL, I forgot the last acronym was for the Ministry for Housing, Communities and Local Government. There have been so many of late. The Select Committee for it last year looked at the PRS in great detail, and one of their very key observations was that certainly the Tory government at the time had no real plan or acknowledgement of the importance of the small-scale landlord in the PRS, and that was clearly playing into the rise in rental growth that had been seen, and that if no plan or acknowledgement was made of the role played by that, then that would have serious implications longer term. I've not seen anything either in the Renters' Rights Bill or the budget that does anything to address that, and let's not forget that was a mixed Select Committee with some Labour members on it. So I think when you look at the Angela Rayner and Stephen Cowan PRS reform consultancy document that they released in May this year, the Labour Party, there's clearly, again, that same drive towards professionalisation and reduction of the power of the landlord and the business case, if you like, to being a smaller scale landlord in favour of a more professional sector. Now, of course, we want better rental housing, we want better tenant management and welfare and so on. We want better physical housing stock. And part of that is perhaps mixing up the people who are invested in the sector. But there's very little incentives on the flip side for people to come back in and invest into new stock.
There's an overarching assumption that small landlords are not as good as big landlords, which does seem to be the case. Quite an assumption.
It's a big one.
And certainly not one that I see day to day being necessarily the case.
No. And more fundamentally, I mean, you're talking about slightly different financial business models there. The old buy-to-let business model, certainly up into the financial crisis, was, well, I'll buy a buy-to-let or I'll retain that extra home that we had and we don't use and rent out. And I don't really mind about rental growth. I'm not really interested in it. As long as it washes its face, I'm happy to keep the rent where it is. Nice tenants are nice. As long as I don't get any voids, I'm going to double my money in capital growth in X years, 7 to 10 years or whatever. And I'm going to keep it as my pension investment, being the classic phrase. So the rental growth was always fairly muted because it was never really kind of the plan of those types of landlords to grow with inflation plus one plus whatever.
But over that time, it's become harder to wash its face because of
And then if you're then managing those landlords out and you're replacing them with companies whose financial model requires you to have rental growth or inflation beating rental growth of RPI or CPI plus one, then effectively by changing the sector, you're baking in rental inflation of a certain level.
Just the T increase is in a long line of measures over the last 10 years, effectively, with mortgage interest relief going, and it's not going to get any easier.
Death by 1,000 cuts.
Vijay, you've got a long memory. Mortgage interest relief was 1988.
Well,
you were still in shorts.
Oh, still in shorts. I'm still in shorts.
On that SDLT point, where are we? We've gone, your second home, additional SDLT is 5%, but it can be a buy-to-let, it can be a holiday home, and even a corporate acquisition. So if it was George Walker Trading Limited and I buy a flat, it's 5% more than the regular. Is that right?
It was at 3%. It's an additional 2%, so it's 5%. Clients generally initially price that in, or there's a negotiation if there's contracts out. And then it's just priced in. It's a one-off charge. So we're finding that it's not deterring our clients to continue their acquisitions. It's a negotiation between seller and vendor. Exactly. I don't know how you found that, Richard, during your auctions, whether there was any change.
The truth of it is it's too soon for us to do it, but we were talking before we came in here, and that's exactly how I expected it to play out, is that if you had a contract or had exchanged or about to exchange, private treaty or anything, it was a great opportunity to bring the price down, to factor in that increase in tax, and the market going forward will factor that in. And as Vijay alluded to, the past 10 years or so, the resident investment market's been clobbered left, right, centre year on year with various different measures. But it still goes on. It's just slowed down that growth, but the growth has still been there generally over a 10-year period, and I don't see that changing.
No. And it's not happening in isolation from just the budget, right? The Renters' Rights Bill significantly increases cost risks for landlords.
Because that's what we were saying is, again, time will tell, but what we've experienced in the past 6 months, I was asking Seb before we came in, is that actually the bigger impact on private landlords, small landlords to big landlords, is coming next year with rental reform and regulations on EPCs and the capital expenditure you have to put into these, that's, I suspect, that is going to have more of an impact than what happened in the budget.
Yeah, I mean, there's a very clear sentence byline to Labour's kind of philosophy on this, which is measure the PRS, manage the PRS. And that's a direct quote from their PRS reform document earlier this year. Hence why you're getting a mandatory PRS database for those landlords and dwellings. You'll have to pay a fee to be on the database, of course. In order to get on the database, you're going to have a decent PRS home standard. You have to tick all those boxes. And again, that's going to come through in secondary legislation. So we don't quite know what's going to be in that. But they're clearly thinking about minimum energy efficiency, dwelling standards, physically speaking, AWEB's law, things like Wi-Fi, minimum Wi-Fi accessibility has been talked about. Minimum accessibility from a disabled disability perspective has been talked about. So all of these things are little sort of extra mechanisms by which the nature, tone and sort of physical makeup of the PRS is being changed incrementally through additional bureaucracy and administration. And all of that starts to feel very kind of a barrier for that smaller landlord to try, and they're being required to turn into corporate or think like corporations effectively in businesses.
Perhaps
when
that's
they're
a
not.
good thing.
Perhaps.
I think it depends where you are, though, as well.
Perhaps.
In as much as if you are in London in the southeast as a landlord, yes, it's still going to be a cost to you, and it's a relative cost, but you've got reasonably high value properties where you're going to get capital growth and it's still worth investing. If you've got investments in northeast, northwest, where the house is worth £50,000 and you've got to put new windows, insulation, Wi-Fi, and it's going to cost you 15, 20 grand, and your rent's not going to really change.
The game's not worth the candle.
And those areas are the areas that need that structure and need those sorts of landlords that are going to look after properties. And that's not going to happen. That's the fear, I think.
But it's interesting that we could go around on this and we've talked about regulation in the resi sector for some time, Richard, but you just had £100 million worth of sales. So your buyers, they must be thinking they understand this and they're happy to, and they're not buying a huge discount, are they?
No, they do. And you're right, George. And without, I think I said this so many times in this podcast, I don't want to oversimplify what we do, but in the resi sector where it differs from commercial fundamentally is that we have an increasing population at quite a rate. We've had decades of a lack of investment in development, and therefore the basic supply and demand is getting stronger and stronger, and that will override pretty much anything.
The Centre for Cities a couple of months ago did a report that suggested since the war we've built 4.3 million fewer homes than our peer group nations in Europe. That's our kind of...
In comparison to a population growth.
Correct, yeah. And dwelling quality and sort of natural obsolescence. So 4.3 million fewer homes in this country than we should have had since the war.
So I think that's ultimately what it is, George, and it's going back to what Seb was saying, is that I think there has been a window for the past 2 years because of interest rates where investors are able to get higher yields and better returns than they have historically because they were willing to take low yields covering washing its face because of capital growth. It's shifted a little bit, but that'll change again. Vijay?
Richard, are you seeing new entrants into the market?
All the time.
Yeah.
All the time. I suppose, as you would expect, we are selling properties from £40,000 to £6-7 million. So it's a really wide selection. So there are some real entry level opportunities for people that want to buy to let invest or, add value, do upsell on. That still exists without question. It very much depends on where the geographical spread is of the properties we get. But all the time, much more so than you would in the commercial sector because of value.
Yeah, well, we find the same with our legal work, new entrants into the market all the time. There's an appetite, and these uncertain times, I guess, create opportunities.
Where's the source of funds there from? Are they UK-based businesses, Vijay, that are...
UK-based businesses predominantly generating cash, and it's a question of where do you invest, where do you take opportunities, and if you're not leveraged, there are opportunities in the market at the moment, especially when there's a little bit of uncertainty and people are a little bit uncertain about all the new legislation coming in.
To put it into context, it's not the most accurate measure of how many new entrants there are to the market, but it gives you a flavour, is that we have to AML check all the bidders that come to auction, a bid at auction, not just the buyer.
Yeah.
Last year as a business, and don't get me wrong, there's SPVs, there's slightly different dynamics of what you do. We did over 12,500.
It's a lot.
Yeah.
Huge amount.
Yeah. So
12,500 new people cleared the AML process.
Entities, don't get me wrong, there'll be somewhere
new entities,
their SPVs and stuff, but it's always changing, which is great fun, but there's a lot more new entrants to it, depending on the value of the stock you've got, I'd say.
You mentioned earlier, Vijay, a lot of your longer standing clients have moved into financing. Are they backing away from that? Or they?
Yeah, they are. They're slightly backing away from that. There's a less of a demand for that type of financing. I would say 5 years ago, there's a lot of financing deals which were happening. Clients who were lending to smaller developers who would then get planning and then develop out those units with Help to Buy gone and all the interest rates which have been increasing. There's no ready demand for those flats to be sold. So the demand for finances has dropped off.
Going back, sorry, we're going zigzagging. That's what we do, though, isn't it, George? Going back, though, it's a short period of time since the budget, and most of what came out of it had been leaked, and we knew where it was going. So there is an element of things pricing in. But where you sit in the past few weeks, from just before the budget, things pricing in and leaks and whatnot, and to what was actually delivered, have you seen a change in sentiment and conversations with your clients? I'm going to sit tight, do nothing, I'm going to buy more, I'm going to chip the price?
It's quite interesting because coming up to the budget, there was quite a lot of uncertainty, and I guess clients are quite adaptive to uncertainty, and whether there was going to be increase in dividend rates or whether there was going to be increase in capital gains tax. There was a lot of speculation what that budget was going to entail. In some respects, they feel that they've got off fairly lightly with just a stamp duty increase from a property perspective.
Do you think that's why they leaked that capital gains tax sort of scare 38, 39% rate early on? It could be this bad. It could be this bad.
Yeah.
Oh, no, it's not.
It was just like doing a job of an agent, isn't it?
really was.
Well, you might get that, but you probably won't.
And it was really transparent, actually. They were doing it the amount of leaks we had are unprecedented. Even the Speaker sanctioned them for the amount of leaks that's happened pre-budget.
Seriously, yeah.
So there was a bit of a sigh of relief from a property perspective. We felt that we got off quite lightly.
For what it's worth, exactly that. When we were asked, what's the house view? And the house view in a few words was, it could have been worse.
It could have been worse.
Or we were expecting worse. And that was probably quite deliberate, as you say, Seb, being cynical.
I'm surprised there wasn't anything on council tax, personally. I think that's an area that I was expecting after 100 days of thought. I thought there was going to be something mentioned on council tax, fairly significant.
I mean, the high net worth got away quite lightly without wealth tax, without council tax. When you transact on the second home, you're going to get hit, but actually, as you stand, you're not, which is great. It's great relief, quite frankly, for everybody. Now, with my commercial hats on, so there was some really positive news on the rates. They've lots of promises about examining rates, but rates relief has not gone away. It's been reduced a little bit, hasn't it?
Yeah.
So the owner of small shops and pubs is going to be a bit better off than perhaps they thought.
The cliff edge is not quite as steep. Yeah, from the COVID sort of 75% relief provisions expiring, that actually just that now not being down to zero and actually going down to 40% is better. Whether or not that's offset by things like the employer NI, though, it will come down to every business. Similarly, the minimum wage increases, again, are going to hit that sector probably adversely because, particularly if they're employing students, an extra, £1.20 per hour per employee.
The minimum wage is very real, isn't it?
It's very real, very immediate, has an inflationary impact generally anyway, possibly to the tune of 0.2, 0.3% on the CPI, but equally from a smaller or from a food and beverage or small retail operator, again, you could be saying that over a couple of years you're looking at not employing an extra employee cumulatively. There's some real questions around how the impact of that is going to impact into the economy, and it's mentioned by the OBR in their impact analysis, for example.
But so let's chuck in another thing. And this is George trying to be really positive here. Chuck £70 billion into the UK economy, an extra £70 billion every year.
Sure.
That surely to goodness will create a positive vibe.
Do you want a personal view or the OBR's view?
I want the truth, Seb. We're here to examine the truth.
Post-truth politics, George. Look, I mean, there's going to be a short-term blip, certainly. There's a couple of caveats to that. I think the government are trying to target certain sectors for growth, and there's very specific dumps of money into things like life sciences and biotech and aerospace and other things that are specifically mentioned. Equally, infrastructure projects, so the HS2 to Birmingham to Euston is happening. Trans-Pennine Railway is being upgraded. East-West Rail is happening. So these are kind of localised sort of investments.
This is Hoover Dam level of infrastructure spending.
Yeah, I mean, it's big. Yeah, it's big, and it's nice to happen. I mean, albeit at the same time, we know that some of that money isn't particularly well spent. We know from our £100 million bat fence that was news that came out in the last couple of days. It's not particularly well targeted, shall we say, potentially. In theory, probably the most interesting one for me from a kind of a commercial perspective is actually, again, it's a residential or a housing focus. I mean, if we do get 1.5 million new homes, those homes don't develop in isolation. They have to be serviced, they have to have employment centres with them, they have to have commercial property with them, they have to have retail, they have to have office, they have to have industrial, and so on. So there are certainly positives for the commercial sector in and around the targeted government spending in some of these sort of new towns, new houses, housing developments, and particularly, I would say, the affordable homes sort of thrust that the government is trying to pull off, which again will require commercial opportunities, commercial space, employment space, educational space, and so on all attached to it. So my hope is that there's definitely trickle-down effects into the regions in commercial properties in these areas. At the same time, that we know, and we all know that the nature of our commercial stock and how we interact with it and what it looks like is massively in flux and being refreshed and changed. So yes, we'll probably get some new commercial stock in some of these areas, but equally some of the old secondary stuff that's now past its physical or sort of
past
demand.
its useful life.
It will have to still be replaced, and PD is probably not the answer in most cases because just the buildings won't work for PD. So again, there's still a slight question as to what do you do with this stuff, and I don't think that's been answered.
Certainly, the majority of the properties which were adaptable for PD have been adapted for PD.
Yeah, it happened in 2014 and thereafter, right?
That's done.
Yeah, the resi side of things is, for me, you talk about the scale that you do at the commercial auction versus the resi auction. To be fair, there's 3.5 million commercial properties in the country versus 28 million odd resi. So the scale of problems in the resi market and opportunities are always slightly larger, just by dint of the volumes. But I think some of the trends we see in commercial around occupiers being far more demanding and discerning about the space they use, it's absolutely happening in resi, and it's happening at a stunningly large scale. You can see this in the Land Registry House Price Index. The new build index is running at about 16% year-on-year price growth compared to 2 and a bit % for mainstream. We are seeing a flight to quality in resi.
There's no question of flight to quality in what we do. If our sellers come forward with long-dated income, we have buyers all over it, which is, it's always been the case. We just haven't seen much for ages because people have been holding on to this stock, I think, to fund what they're doing going forward. So Vijay, sorry to cut you off.
Yep. No, I was just going to ask what your view was on rental growth going forward.
Resi rental growth is such a tough one because it's currently running at somewhere in the region of about 8.5% year on year. According, that's mainstream, right? So not the top end BTR and multifamily stuff. In theory, everything that you look at in terms of wages and affordability tells you that is unsustainable. But then equally, general economic theory tells you that if we start taking stock out of that market and demand stays either constant or increases, then simple price dynamics means that's going to continue to rise. The problem really is that there's nothing yet big from government or the market that's taking demand out of the rental sector. There's no help to buy. There's no real first-time buyer incentives or accessibility. The stamp duty thresholds for first-time buyers are reverting to normal in April. If we're getting less interest rate cuts, which it looks like, then a 95% loan-to-value resi mortgage for a first-time buyer is still going to be, certainly in their kind of living memory, far too expensive. It's not for those of us who are a little bit older, but with a 5 to 10 year kind of memory of what a first-time buyer mortgage looked like in the low twos.
Signs and statistics to suggest that more property has come into the market that was previously or recently used to rent as being sold vacant, hopefully to end users.
Yeah, completely it is. Yeah, I mean, that is, the question is it the right type? I mean, if you're getting a kind of HMO-style landlord selling a house rather than a one-bed flat, then the buyer base from your first-time buyer pool it's not what they want, it's not what they need. Labour has historically talked about some form of help to buy thing, at least it was in the manifesto loosely. I think we'll probably see something on the housing market or first-time buyers in the spring budget because I think they have to do something to loosen some of the rental demand.
Vijay?
Sorry, Sam, 8.5% rental yields.
Nationally.
So what was that a couple of years ago?
Generally speaking, rental inflation is normally somewhere between about 2 and 3%. There's a relatively decent correlation with CPI, albeit slightly lagged. CPI is low, rents, and we know the reasons why, renewal clauses and just landlord general expectations, business models mean it's about 0.5 or 1% above CPI, usually with a bit of a lag. It's far above that now.
But throw into the mix, I think that's why you're hesitating on it, because I was expecting that question to come my way as well, is that you would expect, for the reasons you've broadly said, that there's going to be still rental growth in the resi market. However, there is likely to be rental reform.
Sure.
And less landlords in the market potentially,
Sure,
if they can find somewhere else for their money, which is another big question. So it's an impossible question at this moment in time to be really confident in the answer.
It's really tough. I had been thinking about, come December next year, we'd be looking at, say, around 4% rental growth rather than the 8-9% we've had, or 10% in some cases. But then you've got places like Brent, based on the ONS's data, are currently running at about 30-odd% year on year, 31% I think it is year on year as of September, which is insane. And that's a borough that the ONS say they've got better data for. I think one of the main problems, and this goes back to the measure the PRS, manage the PRS idea, I don't think we know what rents are doing, fundamentally. I don't think any of the measures we've had for rental growth, rental inflation over the last decade or so have been in any way accurate to what's actually happening.
Well, we know what they're doing, we don't know to what degree. It's been poorly measured.
But you could also just go
and then you
talk
get poor
to
policy.
Talk to any 25 to 30-year-old in the office and ask them, and they'll tell you quite a lot. It's very hard. There's almost auctions for rental properties in and around London.
George, we touched on it then. What are your views on rents commercially over the foreseeable?
Yeah, I think that the biggest sector we're exposed to in our market is retail, and most landlords with a few assets are saying that it has begun to creep up quite significantly, and they haven't got any voids in their portfolios, which is really good. I think that You mentioned dilapidated stock. There are clearly bits of the UK where there is very little retail demand, but people have. I think we've had 20 years of wobbly rents. I think these pictures are now becoming established, and people with better portfolios are seeing very positive signs with more than one tenant wanting a new shop, which is really good, really positive.
I'm just conscious we're having a great old time and a great old chat, and we're rambling along. Yeah. There was one that we only have just touched on it. People's early views on where we might end up and what impact the Trump administration is likely to have on the property market and the economy in the UK. What a question.
A chat hand grenade, I think that probably is. I mean,
my take is that there's going to be some big old shocks. It's clearly the stock markets, as I said earlier, have gone up and down. There are going to be some shocks that we cut. It's very, very hard to understand. If he's already passed his deadline for stopping the Ukraine war, because he said 24 hours.
He's not imposed that, George, yet. Except it's the 7th of January that's going to happen.
He needs a few days.
Yeah, give him a few days, actually, in the Oval Office.
But no, the point is that there will be some surprises, and that we don't particularly like that. But my market certainly is quite UK focused, so I think we'll be hunkering down a bit.
Yeah,
gents, Vijay, what do you think?
Yeah, my view is the same. We'll see what happens, but really, our market is UK focused. If he is successful in stopping the Ukraine war, then that might give an impetus in terms of confidence in Europe, which has been lacking, really. So I could see that certainly happening.
Yeah, I think we see, certainly within his first 6 months of full office, I think we see Ukraine permanent ceasefire, and I think we see the Middle East tensions simmer down a lot as well. Purely because...
Isn't it bizarre from a side of the Atlantic? We see one of the most combative presidents ever. And you've just said that he's going to potentially curtail two potential very significant wars in the world within 6 months.
Well, we forget
Amazing.
he pulled off the Abraham Accords in his first term, and he didn't start any new wars. So, I mean, to a degree, he's not an expansionist or interventionist American president historically. And I think his one of his key electoral messages was, let's spend this Ukraine money, but on our Rust Belt and on our working class. So, I think he's definitely going to do that. Where it gets a bit interesting is what he does with the American debt situation and the federal debt situation. My sense is, and certainly his I would imagine the conversations he and Elon have had over a glass of wine are effectively this needs to be twittered. It wouldn't surprise me if he goes on a massive cull of government departments and federal employees. In which case, does that reduce America's appetite for debt? Probably over some period. Yeah, that might be good, and then that probably does nice things to swap rates, which would help. It'll also probably strengthen the dollar. That might help from an inward investment perspective. If there's a strong dollar pound, then we tend to see better enhanced activity in the UK or other dollar-backed currencies from the Middle East, for example. So there could be positives to this. The flip side of that is actually, will this government, given its ideological differences with Trump, be able to pull off a favourable form of international trade agreement with them? The opportunity's there, but will they actually be able to do anything on that or want to do anything on it? So actually, will we be able to benefit on that with additional friction? I don't know.
And Richard, you asked the question. What do you think in terms of impact of the orange man on the market?
I don't think it's going to have a huge impact on the resi market, certainly on the auction residential market, if I'm honest with you, for all the reasons we've discussed prior to this, is that there are bigger things at play. Interest rates will have more of an impact on our market over the next 12 months than anything else, in my view.
Totally
simply because there is a lack of supply and lots of demand. I think that will always underpin our market.
Yeah, it may have a positive impact on the living sectors, though. If the likes of Greystar and some of the PBSA operators from the US who've yet to enter the UK market but see the fundamentals here being pretty strong, actually it might encourage some of those over, which is probably very welcome because those are sectors where we need more inward investment. He may have a deflationary impact on us, or he may have the opposite effect, depending on just how risky the world then looks in 18 months' time.
I mean, if he is successful in stopping the Ukraine war, then obviously that benefits the UK from their defence expense as well.
Yeah. Okay, so we think that it's uncertain on Trump, that's for sure. The budget that we were entitled in this podcast, and we haven't talked about it a great deal, except there's a lot of money coming our way, and our concern jointly, I think, is inflation and what that will do to how that will impact the rate of decline of rates. That's pretty fair, isn't it?
It's going to add 1%. It's going to add 1% to CPI by the end of the 5-year period. That's the OBR's prediction. So, it's not ideal.
I think the big fear is that they don't waste the money.
Governments never do that, Vijay.
think it's pretty fair. So look, let's just wrap this up. Richard, can I ask you, if you bought £10 million worth of your resi auction lots yesterday, do you think in 12 months' time it'll be worth more or less?
I think that is a hard question to answer. I mean, the direction of travel for residential, simply because we expect, and that's probably my biggest mistake, is expectation and prediction, money to get cheaper over a period of time. There should be some capital growth, and there is rental growth. The direction of travel suggests that the market should improve, and we're starting to see that by the amount of people that return to the market as buyers and how much property we are selling and how many people are bidding. So I would say yes, I would expect, depending on what you buy, I think residential investment over the next 12 months should improve. And I would, the government have made it very clear that they want to build, and there's a lot of landowners and developers that we deal with that will be rubbing their hands together and looking for some kind of signs that really is going to happen, and that can only be a good thing.
I agree. I've got a positive outlook for resi going forward, but as we were discussing earlier, I think that the thing for me that no government's yet addressed is tapping up that enormous pool of stored equity that the general public are sitting on in their homes.
What, the bank of mum and dad, do you mean?
Well, it's not quite that. So there's a really a niche but interesting Bank of England data set, which is looking at housing equity withdrawal rates, effectively, how much money we put in or taken out of our dwelling stock. Now, that has been running strongly negative since 2008. It's a really good proxy for just how structurally broken the housing market it is, effectively. If we're it's been negative since 2008 to the tune of now cumulative about 600 billion. So we have effectively been using our homes as batteries for wealth to the tune of 600 billion since 2008. Now,
a decade of zero interest rates is pretty helpful for that.
Sure. Yeah, but it's also symptomatic of the fact that first-time buyers aren't able to access the housing market with new debt to offset that. And similarly, we aren't getting downsizers last-time sellers taking equity out of the market. It's all been stored up and acting as a blocker to things. So
do you see that as the next phase of where I mentioned the high net worth has gone away with it? Perhaps are you suggesting that this administration may have a bit of a dig at that source of wealth?
I think they're aware of it. It's certainly in some of their conceptual philosophical documents, policy documents, but it's the mechanism. How do you get that and the buy-to-let landlords, for example, who are selling up and taking the cash out of the housing market, and how do you encourage them to put it back into the housing market in some form to provide the new supply we need, to upgrade stock, to keep it going?
Yeah, you go into commercial auction rooms and buy the mixed use.
There you go, George. How much did you pay for that answer, George?
If you were to ask me that question about 10 million quid in our market, I think that I was one of the agents in January this year bigging it up and got it very wrong. But if you listen to the buyers and you look at the profile and you look at what they're buying, I think the old guard mixed with a 70% new buyers every auction, the old guard are saying now is the bottom. So I've got evidence to suggest that with rental growth solid in retail, with the buyers that we have seen investing in industrials and shops and alternatives, I think it's a very strong time. And I think that these buyers who buy it now are getting it right.
Well, the commercial valuers agree with you, George, so you must be right. If the valuers are saying...
Commercial valuers agree with me. Oh, my Lord, that'd be the first time ever.
Well, this is it. Ed and his team have called the bottom of the market, so if the valuers are agreeing, then it must have bottomed out.
We did 3 months ago anyway. Yeah. People, thank you so much. If you'd like to join another podcast with us or make any comments, it's george.walker@allsop.co.uk or richard.adamson@allsop.co.uk for your feedback. Thank you very much to our special guests, Vijay and Seb, and we thank you very much for your time.
Thank you.
Pleasure. Thank you.